All right, just so you guys know, this is going to be recorded. And one thing I say before all of these webinars is that as soon as you get this webinar, especially if you aren't familiar with options and or this strategy, watch it again relatively soon after getting it, because it really makes all of these nuances of this strategy really sink in. If you wait a week or 2 weeks down the road and want to review after watching this webinar live, then you're going to really be learning it all over again. If you watch it right away, it makes it all sink in and you'll learn it a lot better. All right, having said that, this is going to be on a broken wing butterfly. If you guys were with us last week, we did it on the broken wing call butterfly. This is going to be on the broken wing put butterfly. And this is really one of my favorite strategies, just because you're financing a butterfly with an embedded call spread. So if you guys watch many of my webinars or daily market commentaries that I put out, you guys know that I like to collect premium. I'm not a big fan of buying option strategies unless we have really low implied volatility percentile, which we do have right now. So if you've been watching some of these daily market commentaries, you know that I've put on a few strategies where I'm laying out a bit of premium to get them on, just because with super low implied volatility percentile, the theory is it can really only expand. So if you are selling strategies in very low IB, then that will go against you. And I'll give you examples of that when we get into the live trading. Well, it's not really live trading, but onto the platform anyway. Anyway, my name's Eric Wilkinson. Some of you may recognize me from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I've been trading my own money for well over 20 years now. I'm not here to tell you I'm going to make you rich or that I'm going to make you a millionaire, but I am here to teach you how to take control of your finances, manage your own portfolio, and most importantly, manage your own risk. At the end of the day, I always talk about it, to pay somebody with your hard-earned money that really came from a sales background to invest your life savings is just a little mind-boggling to me. If you spend a couple hours a week and maybe 15, 20 minutes a day on your own portfolio and learning how to take control of that, you guys will be a lot better off. If you looked at all of the embedded costs that you're paying for somebody else to manage your portfolio, that money would increase your yield overall if you were doing it yourself. And I guarantee you guys, if you just take a little bit of time and put a little bit of effort into it, you can do it just as good as they can. That is about the only guarantee I'll give you. Anyway, I've traded in most markets throughout my career. I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of those products and in all market conditions. I've pretty much seen it all. I wasn't really trading during the crash of 88 Black Monday, but other than that, I've seen just about everything. I mean, I've traded through 9/11 and everything else, so those have been some pretty crazy times. I've got to go over a couple disclaimers, a little housekeeping here. I have to say that any opinions, news, research, or other material provided by ProTrader Strategies or associated companies or employees is for general commentary. The reason why we can't give you investment advice is because we don't know your risk parameters. We don't know what's in your portfolio. So some of these things can be counterintuitive to what you're already doing. We're here to teach you guys some different tools that you can implement into your portfolios, but you need to do that in your own way, because I can't tell you a particular underlying is good for your portfolio, because it may very well not be, because of the rest of the things you have going on and or what your risk parameters are. And we have to say the past performance of any trading system or methodology is not necessarily indicative of future results. Right, like I mentioned, this is going to be on the broken wing put butterfly, and the idea here with all of these different webinars and all of these different strategies is to implement several different strategies into your portfolios at any given time. You shouldn't just be a one-trick pony where you only do call spreads, you only do put spreads, or you only do an iron condor. You need to have a lot of different strategies throughout your portfolio. Trade small. You know, you don't want to have a big position in any underlying and or strategy. So the reason why is because you're playing with the probabilities here. And I often use the example of like a casino. If you walk into a casino and you are the house, you want a lot of different games going on at any given time, and you want a lot of different players at any given time. Because even if the blackjack table isn't winning right here, the roulette table probably is, or the craps table probably is. And that's the same thing with these different strategies, is one strategy may not work perfectly all the time, but your probabilities, if spread out and done properly, where you are playing the proper probabilities, then you are going to ultimately come out ahead. It's just a matter of probabilities. Just like I also say with a casino, if you're sitting at the blackjack table and you're killing it and you're beating the odds right now all day for like 3 or 4 hours and you're getting ready to leave, the pit boss is probably going to walk up to you and say, hey, you want to stay the night, or you want to go to dinner later on today? Here's a free, because they want you to stay in the casino so they know that their probabilities of winning back their losses are pretty darn good. So that's the same thing as this. Yeah, sometimes the probabilities aren't going to work in your favor, but you need to keep trading small, have a lot of different strategies out there, a lot of different underlyings, and your probabilities will ultimately work in your favor. This broken wing put butterfly is also known as a skip strike butterfly or a wounded wing butterfly. So if you've heard of those terms thrown around, I usually call it the broken wing put butterfly because that's what we used to call it on the floor. And it's a great strategy because you can be mildly bearish. It's a market neutral strategy, don't get me wrong, but you can be mildly bullish or you can be mildly bearish, and it really is going to depend on our strike location, how we pick that. And when we go onto the platform, I can show you how you can construct this strategy. So if I think that it's going to maybe kind of rally a little bit more, it's a little oversold, but I think it's going to rally a couple of points, then I can put this strategy on and wrap it around that assumption. Or if I mildly bearish, I can wrap it around that too, where I think that this market's going to kind of come down a little bit in the interim. You can set it up so it's that way. Ultimately, it is leaning towards the bullish side, despite the fact that we're using puts. And the reason why it's leaning towards the bullish side is because we're going to be collecting a credit for this or doing it for zero. And that, in a sense, gives us a lot of room to the upside and still be profitable. And that's what I like about this strategy as opposed to the regular traditional butterfly. And I kind of hinted on this with the broken wing put butterfly. We do need to have an assumption, just because it's going to determine whether we're going to use the put butterfly or the call butterfly. If we're mildly bearish on this and we really want to protect our downside in it, then we wouldn't want to use this strategy. If we are mildly bullish and we want to, not limit ourselves on the upside, then this is the strategy that we're going to use. So that's why I say you need to have an assumption, because you really do need to have a little bit of an idea as to which direction the market is going to go, or you think it's going to go, just so that you can play those probabilities. If you are always market neutral and things of that nature, maybe you could actually still use this strategy, but you kind of need to have a little bit of an inclination as to which way you want this to go. And one of the keys to any strategy where you're collecting a credit is you need to have implied volatility percentile above 50%. And I'll show you how to figure that out mathematically, and I'll show you how to see this on the trade page as well. And we're going to do this where we collect a credit, or we can do it for zero. We're never going to do this strategy for a debit, because when you're doing this strategy for a debit, the risks will really outweigh your reward. Okay. The nice thing about this, like I said, the stock can rally and we're going to still make money because we've done this for a credit. Now, if you've traded options before, oh, sorry, I got a little ahead of myself. I was thinking I was on the next slide. Sorry. So the setup for this is we're going to be buying one in the money put or at the money put, and that's going to determine which bias we have, if we're slightly bearish or slightly bullish on this. And then we're going to sell two out of the money puts. You could say we're going to be selling an at the money put on this as well. And we're going to be buying one skip strike out of the money put. Now that one for sure is going to be out of the money, at least the way I set it up. Now this is a traditional butterfly. As you can tell, you can lose on either side, and a traditional butterfly is really market neutral. As you can see, when I set up this, it was trading around $17.18 for Micron technology. So you can't really have a whole lot of room in either direction with this before you start losing money. So you really have to have it settle right there at your strike to get your full profit. All right. Now with this one though, what we can do is we can set this up so that we have a slightly bearish assumption. So as you can see on this one, I bought the 18 calls, sold the two 17 calls, and then I skipped that this is puts, my bad. I'm sorry. So I bought the 18 puts, sold two of the 17 puts, and then skipped the 16 strike to do the 15 puts. And the thing that makes this turn into a credit is because, in a sense, and I will show you how this works out when we go to the live again, but there's an embedded put spread in this strategy with the 15-16 put spread that is allowing us to finance this. Now, as I said, this is slightly a bearish assumption because we want it to go down and kind of trade in this area to make it to our max profit at expiration. And we do not want it to go very far below, because as you can see with this strategy, we are transferring the risk to the down, or from the risk of the upside to the downside. So we're transferring the risk of the upside, because if it goes higher, as you can see, we're still going to collect this 9-cent credit going higher, but we're transferring that to the downside. So our risk to the downside is greater with this butterfly, this broken wing butterfly, than it is with the traditional butterfly. Now in this example, this one is the slightly bullish example, where I've changed the strike location, where I did the 19, 18, 16 and skipped the 17s. So as you can tell here, we do not have much room to the downside before we start hitting our break even. We are allowed to collect a little bit better credit, but in this particular strategy, we really are much more bullish, because we want it to rally at least $1, if not more, to start being safe. And then I will show you a way that we can transfer this risk back out of the downside and put this butterfly on for free if everything else works out okay, which often does happen. So you do have a chance to be able to manage this type of strategy. Like I said, with the traditional butterfly, you got to nail that number. You really have to have it really settle in to a trading range with the traditional butterfly. Whereas with this broken wing butterfly, we're transferring the risk. We have a higher profit potential, but we also have a higher max loss. Remember, we're transferring our loss from the upper end to this to the downside of this strategy. But again, we are protected on an upward move. So our profit target on this strategy, if we are going to go into the strategy, we always need to know, with any strategy for that matter, what our profit target is. Some people like to take things all the way to expiration. I don't. I like to look at things as when I reach a % of max profit within a certain number of days, I'm taking that off. If you watch any of these webinars, I've even on some of the naked strategies and the call spreads and put spreads, give specific guidelines on the days. If I'm within, if I'm only in the strategy for 5 days and I'm at like 10% of my max profit, I'm taking that strategy off, because the likelihood of this strategy working out does not beat taking money off the table. So anytime you have risk on the table, you have risk of losing money, you have risk of making money. So if I can get 50% of my max profit on any given trade within a certain number of days, I'm taking it off. On this one, we're going to go 50% of our max profit. So if our max profit potential on this strategy is $100, then when we reach $50, I'm taking it off. And I'm also going to show you a way that we can, at a certain given time, if we can roll this into a butterfly and have a butterfly on for free, then we're going to try and do that too. Or, you can take that opportunity. So the max profit is a higher strike minus the mid strike plus the net credit received. So that's going to be our max profit. And as you can tell on the one example, let's see if I can find it. I'd have to go back. But anyway, we'll go over this on the trade page as well. So if you remember, the 18 strike minus the 17 strike, we have $1 plus we got a $1.20, or we got 20 cents on the credit times 100. So our max profit on this is $120. Does that make sense? $20 credit. It said 20 cents, but anytime you have a credit on the page, you multiply that by 100. So if you're doing a $20 20-cent credit, it's really a $20 credit. So that's what that is. So it would be $1.20 times 100, so $120. And the max loss is going to be our skipped strike, which would, in that example, be the 16 strike minus the 15 strike minus the net credit. So our max loss would be the $80. So $1 wide minus the credit we received, which was 20 cents, is 80 cents times 100. And that's how we get it. Sorry, I missed my parenthesis here. Should I put that in for everybody so that later when you see it, we know there should be a parenthesis there. Right. So having that said, now our break even is going to be the skipped strike minus the credit. So as soon as it goes to, on that example, 16 strike minus the 20 cents we collected, 15.80 would be our break even when the underlying is trading at $15.80. And this is going to be a play on Vega. Like I said, we're only doing this when there's a high implied volatility. And I'll show you why. When implied volatility expands on you, you can be directionally right on this strategy, but if implied volatility is expanding and you put this on at, say, a 20% implied volatility percent, and it goes up to 30 or 40, you're going to start losing money despite the fact that you could actually be directionally correct. So you don't want those premiums to expand on you. We really want to do this in a high IV where it's above 50, the higher the better, because despite the fact that implied volatility percent can go 100 and stay at 100 as the volatility expands, the likelihood when implied volatility is high and especially using this strategy because this is slightly bullish. You know, we want it to kind of go up so we can still collect credit. That when the market's rallying, we see those premiums really decay quickly because implied volatility is tanking and the premiums are eroding faster. And we're going to try to exploit theta. We don't want to put this strategy on in a very long duration option series. We want to do it as close to, I like to put it on in around 45 days. Obviously, we don't have that luxury right now for the most part. We're at 50 days. And this strategy, because we're doing so many at the money and in the money options contracts, those options contracts that are at the money or in the money decay a lot slower due to the fact that they're wrapped around where the market is trading. So further out of the money options will decay quicker than the ones that are right there at the money or in the money. And like I said, with the theta decay, we're right at 28 days. You can see right here, you know, 35 days to the 7 days, you get 50% drop in this in the theta. Now, if you watch many of these webinars, you know I don't like trading in this area. And although you do get a massive drop in theta, at the same time, your gamma and your deltas are increasing dramatically. And when you're trading with at the money options, when that gamma increases for every dollar move, that affects the delta by that much. So, you know, if the delta is, you know, 50 and your gamma is 35, if that option contract moves up $1, it goes up by $1.50. The next move is an 85-cent delta. So keep that in mind. So I like to try and get all my strategies out of the way before this time frame, unless I'm doing a strategy on earnings calls, which we're having right now. The earnings calls are great for this because you get a lot of volatility contraction really quick, and you also get the theta eroding really quickly as well. So that's why I like using this for the earnings ones. And we're going to be doing a earnings webinar next week. So if you like to trade around earnings like I do, then we'll be talking about the rules of that. But I digress a little there. All right, let's get into the platform. I'm sure you guys are getting bored to tears. So the trading platform, everybody probably knows the market was up pretty big today and really rallying. One thing to note, we had basically a 10% rally from these bottom right here to today. So as a contrarian, a 10% move on anything is usually a time to think about the other direction, but that doesn't fit with this strategy today. Sorry. We plan these a week in advance, so I can't come up with those that perfectly. All right, so let's look at a couple of strategies, a couple of underlyings. As you guys know, here's my watch list that I have up here, and I have the IV percent here, and I had to get TD to set me up with this. They gave me the code to throw in here. So if you like watching the IV percent, this is the most important thing to me. IV percent. I don't care about market direction or anything else, price, as much as I care about this implied volatility, because that, in my eyes, you know, aside from I just know the theta decay that we just talked about and those time frames that I like to be in as a guideline, but this is massively important. Don't trade anything with these low IV, you know, it's below 50. I said it's got to be above 50. And I also want to stay away from earnings unless I'm going to be putting the strategy on as an earnings specific trade. But that's not what we're looking at today. We're going to be looking at the November contract with 28 days to expiration. So that we don't want to play with any of those that have earnings in them. And the reason why, you know, say for instance, this earnings is right before I don't know, when is Apple's earnings? Right before, so that's not a good example. That's just a couple of days away. But say, for instance, right before the November expiration, which is on the 20th, I believe. If it was like the 18th, you can assume that going into earnings, you can see implied volatility starts ramping up as you get into earnings. Now, this is an outlier because that was the August 24 debacle. But you can see implied volatility has a tendency to go rally or go higher into the earnings and then afterwards go down. So that's why I like to play those earnings on a couple of days, because you usually get that really serious spike down afterwards. But we don't want to put this strategy on because we want to see the Vega contract as we're putting this strategy on. So going into earnings or having earnings within this strategy is not conducive to what we're looking to achieve here. Okay, does that make sense to everybody? This webinar is being recorded and will be sent out right afterwards, Trevor. So, and review it afterwards to everybody. And so let's talk about this IV percent a little bit more. As you can tell with Apple, you go into the trade page and you go down here to the bottom. I got too many. Let me close this up. So you go down here, right here is the current IV percent, 34%. So you want something above 50, and that's where you can find that on everything if you don't have it on here. But I like to do this because I can scan down quickly, 80 up, well, we got earnings, and then do it that way. Okay, so I highly suggest getting that set up in your watch list, because that is the most important. All right, so then that wouldn't fit the bill. The other thing we would look at, so go down this chart right here, 51, nope, we got earnings in there, it's threes, never, we'd be buying strategies and something like that. So keep scanning down. Netflix. Now, okay, here's an example though, Netflix, or even Apple for that regard. As you can see, Netflix going into earnings, and since we had this massive move on those August 24th, I mean, that really caused implied volatility to expand huge, right? So if that is an outlier move that generally doesn't happen in the market. So when we have that added into our implied volatility percent, when things normalize, that causes the data to look a little wonky, if you will. So, and that's not as good of an example as, let's say, Apple. So assuming Apple doesn't have earnings, but this goes to the math involved in finding out the IV percent. And the way that you find it out, you have a numerator and a denominator, right? So on the numerator, which is the top of the fraction, you take where implied volatility is trading now, which is this 33, and subtract it from the low, which is right around 17, 18. Okay, so you subtract those two from each other and you get 15, just for easy math, right? And then you take the high, which would normally be this high, minus the low. But because we know that that happened on this massive, crazy day, and how often does that happen? Not very. And it's up to you to make these different assumptions, but I do this a lot, where if there's a massive outlier like that, it's kind of like a diving score, right? They knock out the high, they knock out the outlier low, and then they get their average from there. So it's kind of like that. If the highs are all pretty much normalized, then that's when I would not do that. But because we have this massive one, it's probably throwing our data off a little bit. So I might go to the next highest one, or the ones where they usually are. So like I said, you got the 33 minus the 18 on the top, and then on the bottom you take the high minus the low in the denominator, and then you divide those by each other, and then that's how you come up with your IV percent. So that would be something like 15 divided by 30. So it's, if I went 50, let's say for easy math, 50 minus 20 to get to 30. It's slightly under the 50%, because that makes 15 minus 30 would be 50%. So it's slightly under that, but that's how you figure that out. So that's something to really note. On the numerator, it's where it is now, divided or minus where the low is, and then the high minus the low, and divide those by each other. Okay, and that's how you come up with that IV percent. So if you have a massive outlier in there, you need to know that. So your data is, so it's not 33, it's probably closer to 50, and that might make that strategy work. And in Netflix, the reason why I mentioned with Netflix is because I don't think they have earnings coming out right away. I think we just had them. But Netflix had that, high after we had that spike. It stayed relatively high for some time, but as you can see during their earnings cycles, it usually isn't that high. Although during this earnings cycle, it did stay up there. So it probably stayed up there going into the earnings. But so you can kind of see that usually during earnings, it's right around there. But that earnings cycle didn't work out. TOS does calculate the IV percent for you. I'm being asked, does TOS calculate the IV percent for you? Yes, Trevor. The IV percent is right here at the bottom of the page, okay? I asked them how to get this code so I could put it into the watch list, and they gave it to me. So if you want that on yours, and I highly suggest it, give them a call. They will, share the screen with you, send it across. You can copy and paste and drop it in. It took me longer waiting to get to the tech guy than it took me to have that set up. So it's a great tool. So you need to have that going down. So for, let's speed this up a little bit. So, I was looking at a couple of them. Win just had their, could I put the code in the recording? Raymond, I can't, because to be quite honest, I don't even know where it is, to be quite honest. I had to do the settings and drop it in there somehow, and I wouldn't want to mess it all up for you guys. So just give them a call. Literally, it takes 5 minutes. All right, so let's get into the trade. So just to speed this up, a couple of them. Where is? All right, so a couple of them. Why is that? Everything seems a little. Where is my? All right, so anyway, so a couple of them that I did, looking earlier that have implied volatility percent above 50. There's very few, after those August 24 move, it was like throwing a dart at any of them, and you could find high implied volatility. But Win is one that has high implied volatility, and full disclosure, I do have positions on in some of these. This is in the this account, but I do have positions in some of these stocks, and it's not that I want you guys to buy or get involved in these trades with me. It's because I'm going through these steps just like I would have you do it, and if it fits the parameters, then it fits the parameters. And as you can see, Win does. Win has a little bit wider markets, and they're even wider now, 45 cents. But usually these Win markets are 20 cents for a $60 stock, $70 stock is pretty wide. So that is another thing I look for. You want a lot of players in there. You want a lot of people trading, and you want, the gamma and the theta. So I wanted open interest. So you want a lot of players in there, and as you can see, the volume in open interest here just really isn't a whole lot. So if you're a newer trader, you want to be weary of that. I have this on I put this on because I'm in Las Vegas Sands and wanted to do a little bit of a pairs type trade. Share your setup and we can get it. I don't know how to do that. Well, if we got time at the end or a little bit afterwards, Lou, If you could show me how to do it, I'd share it and you guys can get it. I find that the slippage is higher after hours than during market hours. Absolutely, Rick, because there's nobody in here. It's Friday. Everybody in New York is out at the bars right now, and so same in Chicago. So that it is for sure a lot wider. So, but that's like I said, this is right now wider, but it's still usually, I would want this to be a dime wide at most for the most part, but it is a little bit wider. So another one to look at is Deer. Deer had high implied volatility percent. And we can roll down and see what it is, 66. So that would fit the parameters. See here for an $80 stock, even after hours, we're still at 23 cents, which is a little bit better than what Win was because there's just more players in there. And as you can see, the volume and open interest is a little higher as well. And then let's see, HPQ was another one I saw that had no earnings and high implied volatility. And I do have position on here. So for me, I probably wouldn't put this strategy on this. The Win, I probably would, because on that Win, I have it so wide on those wings that it's probably something I would do. But here again, Win, and this strategy, let me mention that this strategy does work a little easier with more expensive stocks, just because you're getting more premium for those, and then the difference between each strike is a little bit bigger, so you can get this for a credit a little easier. But having said that, one of the best ones I think I found earlier today was in, just for purposes of speeding this up, was Micron Technology. And you can see here for a $17 stock, we have really tight markets. And of course, I always default to the call side, so please forgive me. That's where I just am used to looking over here for the bid ask and then determine my strategies from there. So to set this strategy up, what we're going to do is look at where it was trading. So we're trading right around the $17 mark. So the 17s are out of the money on this strike, and the 18s are in the money. So we're going to be looking at buying the 18s, selling 2 of the 17s, and you can set this up by doing the butterfly and adjusting the prices, or you can do it where you buy this, then hold the control button down, and then click the 85s twice, and then we're skipping the 16, holding the control button down and buying those. What happened? So did I have something preloaded in there I wasn't looking at? All right, let's delete that. Start over. All right, so we're going to be buying the 18s. We're going to be selling 2 of the 17s. All right, control 2 there. So it's a credit there, but then we're going to be skipping. If we were to buy a regular or do the regular butterfly, you can tell if I did the 50s, we'd be doing this for a debit. But because I'm skipping that and buying the 15s, we can do this for a credit. Now, obviously, earlier today when I was setting it up, it was a little bit better credit. I think it was, what was it, 20 cents or something. So, we'll analyze this, and I'll show you what it looks like on there just so you can see it. So right click, analyze trade, get rid of the old one. So there's the trade setup. It looks like the other way. Now what you can do is go back, and I want to show you this because we bought these 15s and we skipped this. And when I was talking about there's an embedded spread in here, we embedded the 16-15 put spread in there, and that's what financed this butterfly. I don't use, Trevor's asking, do I use the broken wing butterfly around earnings with IV greater than 50? I usually use the iron condor or a or just strangle where it's not defined. The reason why I do that is because you know, even with you know, like with McDonald's, I just did the puts also because I thought McDonald's all day breakfast was going to do good. So I play around with a lot of different strategies. This isn't really the one that I use for that because there's just usually a pretty decent move on earnings trades. So I'll go into all of that next week because I have a lot of different things to go over there. It's kind of difficult to go over. And then I'm looking at for a specific delta on this. Well, with this strategy, you're going to be long delta, so you need to know that. When we're trading this, as you can see, the deltas are on, where's my delta on here? Delta is long 10, so you know this strategy is biased to the upside. This is a long delta strategy. When I'm looking at the trade location here, I'm not as concerned as the delta as I'm thinking, you know, what is my thought process on the movement of this underlying. So this would be, when we set it up this way, it is a little bit more geared, as you can tell, to slightly bearish to get to our max profit, but overall, you know, I'm not worried about the upside. So I'm not as concerned about picking the deltas on this as, or looking at the deltas on this as I would be with the some of the other strategies that I've done webinars on that I talk specifically about delta. When you're doing this strategy with the puts, it is a bullish delta. It's long delta. Okay, so what I was talking about with the strategy, embedding the call spread in there. So if we sell for the analyze this strategy, oh, I should have held down, hold on. Sell the 15 calls and buy the 16 calls, and then we change our quantities. This is the embedded so yeah. Oops, I don't want to confirm it's in that. I want to analyze it. So analyze the trade. So it will put it in with there. And as you can see, that's why it's the embedded call spread in there, because you know, if you add that strategy in there, it creates the traditional butterfly that we are looking at. So in a sense, that strategy is the thing that is financing the broken wing put butterfly to get us the credit. Does that make sense to everybody? I know that can be a little confusing, but you can see that when you analyze it, it creates it that way. So another caveat to this, when we are putting on this strategy, and say for instance, the market is rallying, okay? So we put on all right, so let me think about this for a second so I can say this correctly. Let's get rid of these two. And let's say that we were more bullish than bearish. So it was a lot easier to do earlier today when I had it set up. But let's just say that we were a little bit more bullish. So we're going to do the at the money puts for this one. So I'm going to buy the 18.5s. I'm going to sell 2 of the 17.5s. My computer will let me. And then I'm going to skip these 16.5s and go to buying the 15.5s. And so we're getting the 13-cent credit. All right. So if you can, when the market rallies, roll those 15s and into the 16s and do it for a 13-cent debit, then you essentially get this butterfly for free, and that's what I'm talking about. Do you do anything with the market maker move? Yeah, infinite. That's probably because the market's closed, though. But the market maker move, I only really look at the market maker move for the earnings plays. And I specifically look at that when I'm looking at the market maker move. But this is also the market maker move right here, you guys. In the next 28 days, it's expected to move $2. And in the next 7 days, $1. So that's also your market maker move for the different months. Yeah, I'll go over the roll in greater detail for sure. But let me talk about, and I'm working on that. So this is something interesting you can do. So for instance, the theoretical price and market, all right? So you can go up here, theoretical price and market, click on that, go right next to it. This, you can change around and play with it, and it really shows you what happens. The reason why we don't want this strategy to increase implied volatility. So implied volatility for this was, 50%, right? So if it goes to 60%, look what happens to our prices. They all ratchet up a lot. So, you don't want implied volatility to increase. So that's why it's important. But, again, we would put a negative in front of it and hit enter, and you can see what happens then. That's why we really want our implied volatility to go down. So on to when we would adjust that. So for instance, it's the 23rd, let's just say on the 27th. Okay, so this is giving us a future date, and it's going to calculate that. And the stock price, since we did the 18.5s, let's say the stock rallies up to 17.5. So we need to add 26 cents to our adjustment. So we're going to add 0.26 cents. That adds it, and that makes our price adjustment to 18. We want it to go to 17.5. Is that giving it to me? 14 cents, I think it did. Let's just see. Yeah, so it's adjusting. So if our implied volatility, everything works out, the market rallies, and when the market rallies, implied volatility does have a tendency to go down. Implied volatility is a panic kind of rating. As the market goes down, you see implied volatility expand, and as the market rallies, you see it contract. So that's what we would want to happen. In a couple of days, this market rallies. Now the 16.5 puts are trading for 34, and see, it's not going to work. But if these two, if you can put this spread on, the 15.5 to the 16.5 for 13 cents, let's just try and make this work. For 13 cents, it still didn't really work out. We're 1 cent shy of it. But see how if implied volatility went down or the stock rallied, in just a couple of days, which is not really likely, but just to give the example, if we can get this put spread to roll for 13 cents, we collected a credit for it. If we can do it for a debit of 13 cents, then or 10 cents or whatever. But if we can get that for free, that's a nice way to roll into a strategy that is on for free. So you've gotten the butterfly on for free. Now, keep in mind, your max profit will decrease, but your max loss is completely wiped out. Okay, you can't have a max loss then. You can only have, break even or a profit there. So you get rid of your downside risk by rolling that. Okay, does that make sense to everybody? Which was kind of the way I had it on the Analyze tab before, where I had it before I changed it. I had set it up that way. Does that make sense for everybody? All right, good. All right, so that's the best one to set up that I saw. You know, like I said, the higher priced ones are a little bit better. We could set it up several different ways, but the idea is, you know, you can play around with these strikes, and depending on your assumption, get a little further away or more in the money if you think it's more bullish, and you know, if you want to protect from the downside, you want to come a little bit closer down, like the 18, 17, 15 kind of thing. Priceline, yeah, you know, Priceline, what happened with Priceline today? I don't usually look at the charts on these. Oh, it wasn't Priceline that I was thinking of. It was somebody, the retailers were getting crushed today. So Priceline looks like it's pretty good with the, you know, looking to be at the highs or something. You know, I like this more at a lower end of a range kind of thing, just because, you know, we want it to at least be biased to the upside. But Priceline, 72, they got earnings coming out. When are their earnings? The 9th. So let's see here. The 9th, yeah, I mean the 20th is the, so you can see the 20th is when those options would go off the table. So Priceline would probably work out for an earnings call on what, Wednesday night? Is that Thursday that they come out? I think Thursday is when it comes out. So that would be good for something about Priceline has a double top forming. It does, yeah. Tweezer tops, you're right. So, you know, if you know, tweezer tops would mean that's more of a bearish, but bearish setup. So this would not be the strategy in a bearish setup, obviously, because your risk is to the downside. You might look at doing the broken wing call butterfly here if it didn't have those earnings. Does that make sense? And we did the broken wing call butterfly last week, so that one is pretty good. Do you guys want me to look at any other ones? I mean, I really only saw Win, Micron Technology, Deere, Hewlett Packard, and I think it was STRP or something. Yeah, because it has 70. I don't even know what these guys do, but it was on there. And you know, that's the thing. It's $45 stock, 30 cents wide. We're after hours. It probably was a little tighter than that, but that one, you know, would work in that. And they just had earnings. What were their earnings? That's not going to give it to me. All right. We got a couple of them. So Priceline we did SC. Oh, let's see. I don't even think I have these guys on my watch list. Scott Quartz. What are their it's going to start acting funny because we're so after hours. Do you know, Raymond, if they obviously have options on these? I don't even know if I've ever looked at the stock. All right, I'm going to move on just because it's probably going to. ZSPH. ZS Pharma. $73 stock. Oh yeah, they have a high implied volatility for sure. 120%. Do they have earnings coming out? ZS. This is kind of what I do to go through it. Just a easy way to figure out when their earnings are. Looks like their earnings are falling on the 9th, which is in this option cycle we're specifically looking at. So that would likely get me out of this strategy with this particular stock. This is their, holy cow, those are wide. Uh, what's the volume and open interest look like for these guys? It's pretty low. It is after hours. They usually get a little tighter than $3 wide. I mean, I don't go outside of 30 cents wide, so I don't know if that would fit my book on that one. The reason why I don't like that is because, if you've got to figure out what the bid ask is and go in between there, you have to give up so much edge to get in and so much edge to get out that for me, I like it, you look at something like Tesla and it's, really tight. Not that I like or dislike Tesla. I'm kind of flabbergasted that Tesla is doing as well as it is just because they don't sell that many cars. But, they have a pretty tight bid ask for a $200 stock, So when the market's moving and like what Priceline was another one, those high flyer stocks or Google, there's so many players in there that the bid ask gets really tight. Oh, SRCL. And that's really wide right now too. But when the volatility starts expanding and the going gets tough, then those bid asks are going to at least double. So when you get in and get out and there's nobody there, it's a painful getting in and getting out kind of thing. And because I don't like to go to the end of the expiration with it and let it expire worthless, then I don't like really playing with it. Yeah, that looks a little wide. I trade a lot of FANG, Facebook, Amazon, Netflix, Google. Yeah, I do too. I like those for sure. Just because it's not that I love what those people do or I like their product. It's just because there's so many players in there. So that's why I like it. I'm agnostic to what they do. I don't care usually. Something like with McDonald's, I did play that as an earnings play, and I did like the fact that they came out with that all-day breakfast, not because I like all-day breakfast, but because I thought it was a new idea, and people were going to go out and buy breakfast at 1 o'clock in the afternoon just so that they could say they bought breakfast at 1 o'clock in the afternoon. So I knew that was going to drive up their sales a little bit, at least in this cycle. I don't know what it's going to do the next time. I just knew that something quirky like that was going to drive it up now. Okay, so Trevor's asking, what's your profit target? My profit target on this, so if my max profit on this strategy is $120, like we showed in the example going through, then I'm going to be looking to exit this strategy at $60. The other part of the profit target on this is if the market rallies and I can roll into that embedded short skipped strike or that embedded long strike that's in there that's really financing this. So like when we gave the example of the 18, 17, 15, if I can roll the 15 calls up to the 16 calls for the same amount that I got as a credit initially, so I can put the butterfly on for free, then I'm going to look at doing that. I know that sounds a little confusing, but if you think about it, we embedded those 16 puts. That's what's really financing this. So if I initially did the 18, 17, 15 for 20 cents, let's say, and I can roll the 15s up to the 16s for 20 cents in a few days or whatever, I'm going to do that because now I have the butterfly on for free. I have no upside risk. I have no downside risk. And, if it lands right in between, then I get a max profit of $100 because my 18s are going to expire worthless. My 17s are going to expire worthless. And my 16s are going to be worth $100 or $1. Does that make sense? Because 16 to 17? Because you're long the 16s. If it lands right at 17, that's my max profit, that $1 that I'm long on those puts. So, but if it goes to 15, 14, I don't care because I am already, locked in. So it's going to expire worthless no matter what. 0 going up, 0 going down. But if it lands right at 17, I get my max profit and I got it all for free. No risk. Does that make sense? That's my max profit or my profit target or my thought process in getting to that. 50% of my max profit or rolling my 15 calls to the 16 calls and doing it all for free. In the example, are you moving the center strike from 18 to 16? No, I am only moving, let's go back to the micron. So if I had on the 18, 17, 15s, I would be long these 15s. So if I can sell these 15s and buy these 16s for the amount of credit I received initially, then that's what I would do because then I have the strategy on for free. So for instance, we got the 18s, we're long, short the two 17s. Come on. What happened there? Wait, I'm long the 18s, short the two 17s. For some reason, my mouse dying on me or something? You guys hear me clicking on this? Oh, because I'm holding the shift button instead of, sorry. All right, do this again. Long the 18s, short the two 17s, and skipping the 16s to buy the 15s, okay? So if we analyze this trade, that's our objective there. That gives us no risk to the upside. We're collecting a 5-cent credit. So if we go here and I can roll these 15s to the 16s for a 5-cent debit, then that's when I'm going to roll that up. How often does the opportunity to roll for free on the broken wing butterfly happen? Often or rarely? I would say it's about 50-50, to be quite honest. I've never really done a study on it, but it probably happens. You know, the more credit you receive, the more likely it is you will be able to do it. A 5-cent credit is probably not as likely to happen. And if you did it for a 5-cent credit, you know, you can see that it would have to be way up on the upper band and you would be taking away your profit potential that you are already in, right? Because if I was doing it for a 5-cent credit and I'm trading way up in here, which is when I would probably be able to roll that for a 5-cent credit, then, you know, I really need that market to come back down. So that's why, another reason why I don't always do that. But the more credit you receive, you know, and you get to that point, and that's usually when I have the bearish assumption. So it probably would have been closer, you know, to the example we had before, where it rallied from here when we put the strategy on to up here, and then I could roll those. Does a roll turn the broken wing butterfly into a regular butterfly? Yes. So, you know, you can just do it like this. If I change this to from the 15s to the 16s, changes it to that, right? And then we did this because essentially we started out with that 5-cent credit. Let's just say we rolled the 15s to the 16s for a 5-cent debit. That would make our overall trade 0, right? Because we collected the credit up front, but now we paid for another spread. You can see our break even is at 0 and it's all profit in the middle. Does that make sense? All right, so I don't know how to share. That's about all I got for you today. Hold on one second. And then we'll try and get into how you go back to that IV percent. You guys want to stick around. But for those people that need to go. I just want to get my thank yous out of the way. I want to thank you. In later webinars, we're going to be drilling down on different options, components, and how to trade options. Like I said, next week's is going to be on earnings specific. And for you guys that came and joined us for this, we have a special offer for you guys. It's not going to last much longer from what they're telling me, but you get the daily market commentaries, and I basically go over the different strategies I'm looking at. And right now it's in earnings season, I should say. And so you can go to protraderstrategies.com and get that offer. It should be in the chat box there that you guys can click on, and you can get that. We also do, I go all the way back on different 15-minute videos on each of the strategies, so it's like a little refresher course to just kind of touch base on some of these things. It's not as detailed as these webinars. And then we also have these full-on webinars where it's an hour long. The replay for this webinar particularly will be sent to you via email. And if you look in the chat windows, there is a link there for that premium subscription. I don't know why I lost that as I pulled it up. So look in that chat box on the GoToWebinar thing there, and you can click on that to get it. Somebody else, does the roll turn the broken wing? Okay, so yeah. You can you chat in your offer? Yes, you know, if you are part of the membership, I answer emails and stuff like that. If you guys have specific questions on anything that you guys are doing that you want to run it by me, I mean, I can't tell you whether or not it is specifically the thing to do, but I can tell you what I would do. So like I said, that kind of goes back to, I can't give specific advice for what you should do. I can only tell you what I would do and tell you what my rules are around that and how I would play it. And it's up to you guys to really kind of pull the trigger on that, if that makes sense. All right, so like I said, the link is in the chat box. I want to thank you. If you have any questions, you can contact us by calling us at 310-598-6677, or you can email us at trading@protraderstrategies.com. I want to thank you guys all for joining us on a Friday. I know a lot of people have a lot of things going on, probably want to roll out of here right away, but I'll stick around and answer a few questions. It looks like a lot of people have a lot of questions, and we'll try and get that IV% thing shared and to you guys. But thank you guys all. I appreciate all the feedback here, and it's a lot of fun when you guys ask questions, and it's not just me talking to myself, it seems like sometimes. So I appreciate all the feedback, and you guys have a great weekend. All right, so one other question: are you mostly selling premiums, or do you mix different strategies? Lou, I mix different strategies, but I am a person that likes to sell premium because in my eyes, doing the buy premiums is kind of like swinging for a home run. I like to get base hits. I like to increase my probabilities of success, and by selling option strategies, you increase your probability of success rather than swinging for home runs and striking out a lot. Andreas, sorry I'm late. Yeah, you got a little late, but yes, you will be receiving a recording as soon as we come off, and I have to render it, which takes about 20 minutes or so, and then we will send it out to you in an email. So for everybody who was here for it, please watch it again right away, and Andreas, you can watch it at your leisure, but for you missing it, maybe watch it a couple of times, give yourself an hour to let some of this stuff sink in, and then watch it again, because that will really make all of it sink in. If you missed it earlier, I said for anybody that was here for it, watch it again. It'll make it sink in as soon as you get it in an email, and I would suggest you kind of watch it as well. You can send in questions. Yes, you can send them into trading@protraderstrategies.com, and I will get to those questions as soon as possible. But if Lou's still around, you want to tell me how I can try and share this this settings thing here? Lou, are you still there? I don't know how to share this code. All right, looks like Lou's gone. I don't know how to do it, you guys. But call TOS, ask them how to get that link in there.